Ladies and gentlemen, good day and welcome to the Escorts Limited Q4FY19 earnings conference call hosted by SBA Securities Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Pavitra Subramanian from SBA Securities Limited. Thank you, and over to you.
Thank you. Good evening, ladies and gentlemen. On behalf of SBA Securities Limited, I welcome you all for Escorts Limited Q4FY19 earnings call. I also take this opportunity to welcome the management team from Escorts Limited. Today, we have with us Mr. Shailendra Agarwal, Executive Director, Escorts Limited, Mr. Bharat Madan, Group CFO and Corporate Head, Mr. Shenu Agarwal, CEO, Escorts Agri Machinery, Mr. Ajay Mandar, CEO, Escorts Construction Equipment, Mr. Deepankar Ghosh, CEO, Railway Equipment Division and Investor Relations. We would start this call with a brief opening remarks from the management, followed by an interactive Q&A session. Before you start, we would like to add that some statements that we make here will be forward-looking in nature. At this point, I am handing over the session to Mr. Madan for opening remarks. Over to you, Mr. Madan.
Thank you, Pavitra.
Thank you, sir.
Ladies and gentlemen, a very good evening to you all. Thank you all for joining us on the earnings call for fourth quarter and financial year ended 31st March 2019. A snapshot of company's standalone annual performance is as follows. FY19 was a tremendous year for your company, achieving a turnover at rupees 6,196 crores, which is up by 23.5% against 5,016 crores in previous fiscal, led by double-digit growth across all segments. Tractor volumes went up by 19.9% to 96,412 tractors as against 80,417 tractors in previous fiscal. Construction equipment volumes up by 23.5% to 5,544 machines against 4,486 machines in previous fiscal. Is the highest ever EBITDA of rupees 733.4 crores, is up by 31.6% as against rupees 557.2 crores in previous fiscal. The EBITDA margin now stands at 11.8% as against 11.1% in previous fiscal. The EBIT margin for the company have gone up by 100 basis points at 11.8% against 10.8% in previous year, in line with our guidance for this year. Finance costs went down by 10.1 crores to rupees 18.5 crores as against rupees 28.6 crores in previous fiscal. The total debt outstanding as of March 19 is rupees 277 crores. It's increased due to increased working capital requirement. Net debt, however, continues to remain negative at about 200 crores. PBT from continuing operations and before exceptional items stands at rupees 710.2 crores, is up by 37.8% against rupees 515.6 crores in previous fiscal. The company achieved the highest ever net profit at rupees 484.9 crores as against rupees 344.7 crores in previous fiscal year. The board of directors have recommended an increased dividend payout at 25%, that is rupees 2.5 per equity shares for the year ended 31st March 2019 against 20% in the previous fiscal. Now moving on to company's quarterly performance, the turnover is up at rupees 1,631.7 crores, up by 13.6% as against rupees 1,436 crores in previous fiscal. Tractor volumes up by 6.7% to 25,136 tractors as against 23,568 tractors in quarter ended March 18. Construction equipment volume went down by 5.6% at 1,455 machines as against 1,541 machines in quarter ended March 18. EBITDA is up by 9.3% at rupees 189.8 crores as against rupees 173.8 crores in quarter ended March 18. Net profit for the quarter at rupees 121.4 crores is up by 7.8% as against rupees 112.5 crores in previous fiscal same quarter. On consolidated basis, the turnover at rupees 6,261 crores is up by 23.2% against rupees 5,080 crores in previous fiscal, and net profit at rupees 474 crores as against rupees 346.6 crores from continuing operations. The consolidated EPS stands at rupees 55.67. Now moving on to segmental business performance, starting with the agri machinery business. Domestic tractor industry volumes went up by 8% to 7.87 lakh tractors as compared to 7.29 lakh tractors in previous fiscal. Our domestic volume went up by 19% at 93,323 tractors as against 78,446 tractors in previous fiscal. Industry in our strong markets of northern and central India grew by 12.8%, whereas industry grew by only 2.6% in the opportunity market of the southern and western India. In line with our Vision 2022, we have gained market share across all major states. Our market share in strong markets went up by 70 basis points, and in opportunity markets it went up by 120 basis points, resulting in overall domestic market share at 11.8% as against 10.8% in previous fiscal. Market share for quarter ended March 19 at 15% went up by 191 basis points as against 13.1% in corresponding period last year. On export side, industry went up by 4.2% to 93,000 tractors as compared to 89,000 tractors in the previous fiscal year. Our exports volume went up by 56.7% to 3,089 tractors as against 1,971 tractors previous fiscal, driven by new product introductions and market penetration. The EBIT margin for year ended March 19 stands at 14% as against 13.6% in the previous fiscal year. During the quarter ended March 19, the product mix was unfavorable as we sold 56% product by volume in sub 40 HP segment as compared to 53% in the previous fiscal same period, thus adversely impacting our EBIT margin in the tractor business. In Q1 FY20, domestic tractor industry is expected to witness some slowdown because of elections against initial guidance of our double-digit growth. On full year basis, domestic tractor industry is expected to grow between 5 to 8% depending on how well the monsoon fares and the government trusts and the policies against the rural markets. Last week we have launched a new feature called 24/7 care button for customer service across entire range of power track and farm track tractors. Now all our customers can just press a special button on the tractor any time of the day for any technical or other help and receive a call back from a trained company engineer within 2 minutes. Going forward, we will be launching new innovative products to increase our customer productivity and earnings. Coming to the construction equipment business, construction equipment industry grew by 16% in FY19 with respect to FY18. All major segments have seen a positive movement. Our served industry, backhoe loader, pick and carry cranes and compactors went up by 22.6% in FY19. Cranes have been the biggest gainer in FY19 with growth of 26%, followed by backhoe loaders that grew by 22.2% and compactors that grew by 20.5% in FY19. Our total volumes manufactured and traded products went up by 23.6% to 5,544 machines against 4,486 machines in the previous fiscal year. EBIT margin for the year ended March 18 stands at 3.6%, up by 166 basis points as against 1.9% in previous fiscal. Barring some slowdown on account of financing issues, ongoing central elections and external environment will be improving our margin in FY20. Going forward, we expect that our served construction equipment industry will continue to grow in mid-teens in medium to long term and will be launching new innovative products and variants to cater to this growth. Coming to the railway division, revenues at rupees 394.1 crore went up by 37.5% as against rupees 286.6 crores in previous fiscal. EBIT margins went up by 529 basis points to 19.9% as against 13.9% in previous fiscal. In Q4 FY19, revenue went up by 30.2% at rupees 103.5 crores as against rupees 776 crores in same quarter of previous fiscal. EBIT margin at 15.2% as against 15.9% in same quarter of previous fiscal. During the quarter, we have executed more orders for the new products with more import content as compared to previous fiscal, which led to some impact on margins. In future, though, we will be able to mitigate the impact with gradual localization of these components and improve the margins. Order book for this division stood at more than rupees 490 crores, which will get executed in next 14 to 15 months. Going forward, we expect railway equipment segment to grow at 15 to 20%. Now I request the moderator to open the floor for Q&A, please.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may please press star, then 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star, then 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask a question, please press star, then 1. Also, as a reminder, in order to ensure that the management is able to address questions from all participants in this conference call, please limit your questions to 2 per participant. If you have any further questions, you may come back for a follow-up. The first question is from the line of Raghunandan from Emkay Global. Please go ahead.
Thank you, sir, for the opportunity. Congratulations on a good FY19 and all the best going forward. Sir, a couple of questions. One is on the tractor side, how do you see the growth panning out over the next few quarters, which will finally accumulate into a 5 to 8% growth for the full year? Also, how is the competition intensity? Like of late, there has been some slowdown leading to, higher competition both on the pricing side and on the discount side. How do you see that panning out? That was my first question.
Okay, this is...
Secondly...
Yeah, let me...
Yes, sir. Please go ahead, sir.
Okay, let me answer this first before you ask the second question. And this is Shenu Agarwal from Agri Machinery Business. So, as we have said in our opening comments, the tractor industry is going to be somewhere around 5 to 8% growth level in fiscal year 20. That is what we can estimate right now. Of course, there has been some pressure in the industry since Q4 of last fiscal, and that is mainly because of a very, very high base. As we have explained before, that Q4 in 2018, the industry had grown by about 49%, so we were sitting at a very high base. And therefore, this year, Q4 2019, there was kind of a negative growth that we have experienced, which was also kind of foreseen because of the very high base. Now, this has continued a little bit in Q1, mainly because of some disruptions because of elections and some amount of uncertainty. But we continue to believe that fundamentals on the ground are all positive, except that we have to wait to see how the monsoons pan out, because right now the water reservoir levels are quite low. And therefore, we are hoping that as per the IMD forecast, if we have a normal monsoon, then we think there will be there could be a better scenario panning out. And right now, our estimate is between 5 to 8% for the year.
And what I wanted to understand was, sir, Q1 is lower than what was initially expected. How do you see the growth picking up? Would it be stronger, post elections? How do you expect 2Q, 3Q, or 4Q to pan out? Because the base effect still continues.
Yeah, so base effect is not that high as it was in quarter 4. Because whole year the industry last year grew only by 8%, while quarter 4 was very, very substantial at 49%. And therefore the base effect is not that enhanced in Q1, Q2, Q3 as it was in Q4. But in any case, we think that after elections, the market should return to some normalcy. And there has also been an effect in March and April of some delayed harvest, and the market has still not picked up until now. But I think when the harvest will be over, I think the market will pick up. And we have seen some signs of that happening in states like MP, where the harvest is almost complete and the market has become very buoyant already. Right? So we think that after the harvest and possibly after the elections, the market will see some growth back, which we haven't seen in March and April.
Thank you, sir. Sir, my second question was, how has been the mix between Power Track and Farm Track for the full year versus last year? And also, has Power Track been launched in all the Farm Track states? Is there any further scope for penetration there?
So yes, so as far as mix is concerned, I think Power Track and Farm Track is, as a ratio of the total sale, is pretty much same as it was last year. There's only slight changes. As you know, we have a strategy to grow both the brands, and we have a dual distribution strategy which we have put in place for the last couple of years, and we are extending. In last 2 years, we have now created a dual distribution separate for Power Track and Farm Track in about 6 states. And now, going forward, we are going to continue to implement that strategy in the rest of the states also. Right? So in the next 2 to 3 years, we hope that we have a pan-India network for both the brands, separate distribution network for both the brands, including the South.
Thank you, sir. I'll come back in the queue for more queries.
Thank you. The next question is from the line of Hitesh Goel from Kotak Securities. Please go ahead.
Yeah, hi Bharat. My question is two. First is related to the EBIT margins in segments. In tractor, I understand there's a mix impact which has impacted the segment, but construction margins have been pretty volatile. So can you please explain what has happened in this quarter and how should we look at construction margins next year? And in railways also, first half this year was very, very strong, and then margins have come off. So how should we look at margins in railways as well? And my last question will be on the balance sheet. Basically, you've seen a significant deterioration in working capital. You have been indicating that dealer inventory levels have not increased at normal levels, whereas if I look at inventory at the factory has increased quite significantly, even receivable days has increased, and payables have reduced. So can you just shed some light on the working capital as well?
Sure. So coming on the construction equipment segment, I think if you look at the current quarter performance, and typically like for construction sector, the last quarter is the best quarter. And also in this quarter, we've taken a significant price increase actually right from the first month in January itself. So that was one of the long pending issue, which was impacting the overall margin for construction equipment segment. So we're not able to pass on the inflation to the market for almost last 5 to 6 quarters. So this time we've taken that call and actually took that conscious call, which led to probably some volume impact also, which you've seen in this quarter, with volume went down by about 5.5%, but the margins have been pretty good at about 7% EBIT margin, which we achieved in this quarter for the construction equipment segment. So overall, I think if you look at full year basis, we are still lower than what we had guided for. We had expecting 4 to 5% sort of margin in this business in the full year basis, but because of this delayed passing on the inflation impact, I think it had some impact on the overall margin, which still ended at about 3.6% last year on construction side. So going forward, I think next year we we should be able to improve the margin. So again, should be back to about 4.5 to 5% sort of range on a full year basis. And then coming to the railway front, so like I said, in railway, a lot depends on what sort of mix we sell, because every order is unique. In the first quarter in this fiscal, we had sold a very large order which we had received was on account of couplers, where the margins are very good. But going forward, obviously the mix started going down, and if you've seen in the last quarter also, the maximum sale which happened, 37% of the volume on the railway side came from the new products, where the margins have been pretty low because of the high import content which we have in those components today. So overall, we think still we ended the year with about 19.9% EBIT margin, and for next year we still expect the growth is happening more on the new product side. So overall margin may be slightly under pressure compared to what we actually seen in this year because of this large order which came on the coupler side. But still it should be anywhere between 17 to 18% sort of range on a full year basis for next year for railways, and given the kind of order book which we had today. So the other question was on the working capital. Yes, I think we have been facing issues on the working capital side because the growth momentum which continued in the first 3 quarters of the year was very aggressive. So we actually were looking at expecting very good quarter to go in Q4 too. In fact, if you remember, even for Q1, we had actually guided probably the growth rate will be somewhere between the double digit at 10 to 15% range. So obviously our production was running at a high utilization levels in December and January also, which are typically the off-season months, which led to some impact happening at the year end because all those production, my tractors which got produced, which were still lying in the inventory, because this time the Navratra season got shifted to April and we're expecting the season will be very good. But actually we didn't see much pickup happening in most of the key market, including market like Gujarat, which typically is a high season market in Navratras, but they also see decline actually this time. So that had an issue on the impact on the inventory side, on the receivable side, and also because the payables and most of the production happened in the initial months of December, January, and after that we took a cut down on the production, so the payable days also went down at 31st March. So if you look at the debt level also, which is actually moved up, so even though compared to the last year's numbers, we were actually on a negative debt position. It's only 50 crores of term debt was there, but we had 600 crores plus of cash on the balance sheet. This year we ended with only about 200 crores of cash on the balance sheet on net basis. So about 400 crores actually got utilized in this year because of the working capital issue which the company had faced. But we are correcting that situation because these are most internal in nature, and we think another 3-4 months time we should be back to the normal working capital levels. So maybe by July we expect we should be back to the position which we were in. The cash should be back on the balance sheet.
So July, basically, you're expecting it to become negative working capital, right?
So we actually cut down on inventories and production also. So obviously that impact will take time by the time your vendor payment gets really realized and gets impacted. So I think it takes about 2.5 months time. So hopefully that correction is setting in now. So hopefully by end of July we should be back to the normal position there.
Okay, great. Thank you. All the best.
Thank you.
Thank you. The next question is from the line of Mihir Javeri from Avendus Capital. Please go ahead.
Yeah, thanks for this opportunity. I just want to know when we talk about inventory, what is the inventory situation right now, sir?
So inventory you said with the channel or with us?
Both.
So I think with the channel, like you said, so obviously in the end of March, we were at close to 4 weeks of inventory with the channel partners, which also was slight build-up compared to the 3.5 weeks, which was running till February, because we did the build-up only because the Navratra this time were in the first week of April. So we were expecting it will be a good season, so that's why some build-up happened at the end of March. But now, as you probably will exit the month of May, I think you should be back to the same level of about 3.5 weeks or sort of 4 weeks of inventory level, which probably will go down further by end of June. So by end of June, we'll be back to about 3.5 weeks of level of inventory. As for the company is concerned, in March, definitely, like I said, since we had made tractors assuming the season will go off well, but again, since the correction had to be taken, so cut down happened and the production numbers going forward in April and May also be cutting down. So again, by end of June, we should be back to, normally we maintain 2 to 3 weeks inventory with the company. So we should be back to that level by end of June.
Okay. And sir, at the end of the fourth quarter, probably you had guided for a 10% volume growth, double digit, which you said 10 to 15% for Q1. We've already seen a negative number. So is it that the first, and with this inventory correction and all, do we see that the wholesale dispatches probably for the quarter would be negative? Is it fair to assume that way? Because if I were to look at it from a next 8-month perspective, for Escorts, for a company as such, out bearing the monsoon months, the base is pretty high, which is what one of the analysts also questioned. So just wanted to understand how we should look at it from that demand perspective for Escorts particularly.
Ashina, you would like to answer that?
Yeah, I would. So as we said, I mean, more than the stocks, I think this is a kind of a matter of elections, a little bit of delayed harvest, and also a higher base in Q4 that is leading to some pressure on the growth levels, right? So Q1 estimate is still not very encouraging for the industry. We don't think the industry is going to grow in Q1 that much, although a lot is yet to be seen after the election results are out. There is a possibility of some growth coming back. But right now, the industry growth does not look very favorable in Q1. Of course, Escorts has been able to beat the market trends. Whole of last year, we were actually the fastest growing tractor company in the country last year, with about 19-20% growth as against 8% industry growth. So our effort will be towards that to beat the market trends in Q1 as well.
And secondly, sir, how are the discount levels right now in the industry, given that the volumes are not even same question as about competitive intensity, but do you see the discount levels have actually gone up at the start of Q1 versus Q4?
See, I think there are a couple of players who have resorted to a little bit of more discounting, but I don't think that is kind of a trend right now. I think the intensity is same as it was in the entire last year also, right? But I mean, we have just started the year. A lot is yet to be seen. But for sure, Escorts is not resorting to any unusual discounting practices now, or we have no plans. In fact, we are coming up with a lot of new innovations, a lot of new features in our tractors. And we hope that customers would really like these. I mean, I would specifically like to mention, Bharat also mentioned that in his opening remarks about this 24/7 care button. And this is something that we are feeling, we are getting a lot of positivity from customers on the ground since we have launched. So I don't think there will be any significant decrease in competition intensity going forward.
Okay. Thank you. That's all from my side.
Thank you. The next question is from the line of Gunjan Prithyani from JP Morgan. Please go ahead.
Yeah, hi sir. Thanks for taking my questions. Just two follow-up questions on the industry. You mentioned that there's a huge divergence in growth trends between South, West, and North and East. Anything specific that you could, explain to us, like why is this meaningful divergence there? And also, secondly, on the subsidies, have you seen that this year towards the second half, we saw lesser tractor subsidies from the government? Anything that you can give some sense on the subsidy which are being offered?
Sure. So you have seen the trends of, geographical trends in India over last 1 year. I think those trends are going to continue for at least some more time, which means that North, East, and Central are going to grow much more faster than South and West. I mean, states like Maharashtra and actually the entire southern region is going through a very bad phase as far as industry is concerned. With Maharashtra actually going down about 50% from last year in last few months. Right. So I think that trend is going to continue because there are reasons behind that which we don't think will get addressed very, very soon. So I think this trend is going to continue, and this is actually going to be favoring us a little bit more than the rest of the players because we are more stronger in North, East, and Center. Although we have gained market share in almost every market, but overall it's going to be favorable for Escorts.
Sir, Maharashtra.
Second question.
Maharashtra, you mentioned the trend will continue. I mean, this was more an issue of rainfall challenges that were there. But I mean, is there anything else that that gives you that confidence that Maharashtra will remain depressed? In South, I thought particularly there were a lot of subsidies in that market. But still the growth the decline seems to be pretty sharp in that market as well.
Yeah, so see, Maharashtra and South is mainly because of the water situation, and it's not so much about the monsoon. It's more so about the water reservoir levels. Right. So tractor industry, if you analyze it, it does not have as high a direct correlation with monsoon as it has with water reservoir levels. Of course, monsoon impact those, but with a lag effect, right? So water reservoir levels in Maharashtra is quite pathetic right now, also in some states of South, So I don't think even if we have a reasonably okay monsoon this year, the South and West situation will change very dramatically. Of course, it will help for the next year if we have a good monsoon in South and Maharashtra. It will definitely help next year. But I think this year it's going to continue to be depressed. So subsidy, on the subsidy part, it is true that many of the southern states have kind of slowed down their subsidy outlays in the later half of the last year, and even now we don't have any visibility of any major subsidy schemes getting out in the South and the West, and therefore that factor is also playing a little bit negative for those regions.
So overall subsidies accounted for how much volumes in F19, and if you are not seeing any visibility there, does it mean any risk to because last 2 years this has been a big support for the industry in terms of accelerating the replacement?
Yeah, so subsidy has been a major phenomenon in South and West only. I mean, in northern states, we have not seen much subsidy even last year or the year before last, except for Assam, where we had some subsidy schemes that were running by the government last year. So I'm strictly speaking about South and West right now, and the South and West, the subsidy would have been about, I would say, about 70 to 80% of the total subsidy that has been given in the country, which has kind of vanished in the last few months, right? So let us see after elections if something comes up. We are hoping the government will kind of resort to some measures to uplift the rural sentiment.
So overall industry, how much would it be in terms of volumes, like 10% of industry volumes coming from these subsidies, or any number that you can say?
Yeah, so roughly about 10% for the last fiscal. So roughly about, let us say, about 70 to 80,000 tractors.
Okay, got it. Thank you so much.
Thank you. The next question is from the line of Akash Mangani from BOI AXA Mutual Fund. Please go ahead.
Thanks for taking my question. So I had a question on the working capital situation. I know this was asked earlier, but I would like to sort of emphasize on this point. I mean, if I'm looking at the working capital, especially the operating cash flow in the business over the last decade or so, I mean, this year probably seems to be the worst that we've had, I think to the tune of negative 60-70 crores of operating cash. Now, even in the previous cycle when we had sort of down years, we've managed to generate somewhat of a decent operating cash flow. Whereas this year, in spite of a healthy growth in sales, EBITDA, PAT, I mean, there's no cash flow in the system at all. So how soon can we resurrect this, and will this normalize during the course of FY20? And could you elaborate on the reasons which led to such a big deterioration in the working capital? I know you mentioned one or two, but I was not exactly clear on the reasons.
So I think you mentioned, if you look at the growth trend which has happened in the last year in the tractor industry. So first, I think we must understand this is the third year of growth happening in the industry. So the first year in FY17, we saw about 18% growth in the industry. Then again, next year grew by about 22%, and this year again we're seeing about 8% growth overall. But you look at the first 8 months, the industry growth was actually from April to November was running at about 14%. Then December we saw a very small growth of 5%. January was flat industry. February was minus 3%, and March, April we saw 15-16% decline happening. So our idea was, I think till the time we are seeing, and Escorts was growing at double the rate of the industry growth. So if the industry was growing at 14%, we were growing at 26-28% sort of growth level. So obviously the expectation was the growth momentum will continue. So till November, we were actually holding the same belief that Q4 will actually be very good, and probably will be continuing to do that sort of volume growth happening, and will happen in this industry. But assuming based on that belief only, so we actually were running on the high production levels in December and January month to build up inventory for the season months of March and April. Unfortunately, the industry started correcting itself from December itself with a very small growth, and in January onwards that we've seen the flat industry and decline started happening. The sharp decline happened in March and April, which actually came more like a surprise. But initially our guidance was that probably the industry will continue to grow at double digit even in the first quarter. So that has led to some increase in the inventory level which we are holding as of end of March, and also because we actually produced those tractors in the month of December and January. So most of the payment to supplier also had to be done before end of March because all this payment became due. So that led to the payable days also going down. And obviously going forward, slowly we already cut down the production numbers in February and March, looking at the market trend and looking at the current scenario, what Shenu just explained. The Q1 is also not looking very healthy, so it may be flattish or maybe slightly declining quarter in view of the election scenario. The pickup may happen only in the June month after the elections are over. So we expect by end of July we should be back to the normal working capital cycle level. So all the inventory will get liquidated. We'll be back to the normal channel stock of 3.5 weeks of inventory. And also the payable days will come back to the normal trend with all this cut in production happening in the last 2-3 months. So that impact will be more visible by end of July. So by that time,
the receivables?
So receivable again is the same issue because normally when you see the industry is taking continuously for 3 years and we are growing more than the rate the growth in industry. So dealers working capital also comes under a lot of pressure. So even though they have been actually supporting the company so far, but obviously that is putting a lot of pressure on the liquidity side from the dealers end also. So some bit of correction that way I think is good for the industry health too, because the dealer can't afford to cope up with that sort of growth in a very short time frame, because then banks don't really start lending you money just based on that, and they will keep doubling your limits every second day. So that's been a bit of challenge. So I think we expect the debtors level will also come down by I think end of June or by end of July. So which is the hope which we have. So I think by getting back 400-500 crores of working capital back into the system by end of July is what we're looking at right now.
Okay, let's hope we achieve this. The other question is, could you talk of if there are any cost pressures in the tractor business, and what is the outlook on EBIT margins for this business for the next financial year?
So cost pressure, if you talk about the commodity prices, so obviously Q4 we didn't see really much impact on the commodity side, so it was more or less flat quarter, so no really inflation, deflation really happened, and we're not really seeing any pressure from the commodity side, at least in this quarter too. So we expect, I think that sort of level will get maintained. On the overall margin business, I think if you look at the Escorts overall number, last year we had improved our margin, operating margin at a company level by about 100 basis points. And we expect by on a full year basis, even for next year, if assuming we are able to grow at a level of even 5 to 8% of the industry number, what we really talked about, even at that sort of number and the cost initiative what company is taking, we should be able to improve the margin by 40 to 50 basis points over what we ended this year with.
Okay, this is provided you grow at least in sync with industry, right?
At least in line with the industry, that's right.
And if it's okay, got it. Okay, that's all from my side. Thank you.
Thank you. The next question is from the line of Mitul Shah from Reliance Securities. Please go ahead.
Thank you for my question, sir. Sir, I have two questions. One is on the tractor side. Basically, we are saying 5 to 8% industry growth, assuming normal monsoon. So in that situation, because of the last year's lower monsoon in the south and west, base is very low. There is possibility when if the monsoon is normal, those regions will bounce back more strongly. So growth could be much higher in those regions. So, and our stronger market may not grow to that pace. So what is your view in terms of growth in the south and west compared to UP, MP, Bihar, which is our stronger market?
And this is Shen. So Mitul, as I explained, we have seen in the last several years that monsoon does not have a very, very high correlation with the tractor industry in the current kind of period, right? Because the more higher correlation is actually with the water reservoir levels. Now, if the water reservoir levels would have been at a reasonable level in south and west, then of course a good monsoon would have really spurred the industry in south and west. But I think even a good monsoon this year will not have that kind of an effect because people will first wait for the water reservoir levels to come up before the sentiment gets built up. Right? So I think it will have a lag effect just because of the current situation. The degrowth may not be as high as it has been if you get a good monsoon in south and west. But I think north, east, and center will continue to beat south and west when it comes to industrial growth, even this year.
And within this, sir, how much would be approximately non-agri usage right now in current situation, and how much would be purely agri-based, so which will not have even effect of this monsoon?
Yeah, so non-agri usage has become quite substantial now over the last few years, and therefore also this is also one of the reasons why we see that monsoon does not have a very, very direct correlation as it used to be 20, 30 years ago. Right, so non-agri usage is, however, a little bit random. A lot of it depends on the government policies and the amount of expenditure that is done on infrastructure, etc. Right, but just to give you a number, I think it comprises of about 30 to 40% of the impact on tractor purchases.
Okay, sir. My second question is on the construction equipment side. Sir, these Q4 numbers in terms of ASP also very strong, as you stated price hike is taken, but is it any one-time product mix kind of impact, or we can expect similar product mix on a full year basis for next year, or Q4 was inclined towards a better product mix?
This is Ajay with you from Construction Equipment. If you look at the price increase, we were behind in 5 quarters on the price increase side because the inflation was too high and the competition was not passing on the price increases. But we have passed on the price increase in January, and the people have followed us in that respect. This price increase coupled with a better product mix, if you see the overall growth, we talk about 23.6%, 24%, and the top line growth in revenue is about 34%. The mix has changed altogether. So we are more concentrating on the products which are giving us the better contribution now. That's the game that we are into now, and that is what we are doing. We'll continue to do on that side.
So there is no seasonality impact in Q4 in terms of product mix?
No. In fact,
Thanks.
more demand on the growth side. In the quarter 4, if you look at demand was on the growth side because of the run-up to the election and uncertainties, the liquidity crisis in between. So I think going forward with the formation of the right government at the center and with a lot of orders which are already there in the pipeline, I think this momentum will continue.
Thank you, sir.
Thank you. The next question is from the line of Sachin C. from Credit Suisse. Please go ahead.
Yeah, hi. Good evening, sir. This is Jatin. Just on the working capital thing, I also wanted to check on the GST refund side, what's the amount that's still pending from the government, and is that a factor as well?
Jatin, the total amount which is due on GST account as of 3rd of March was close to 177 crores, which is a mix of some inverted duty refund for tractors as well as from refund which is due on account of export. So some of the amount, for example, on exports, we received some amount in month of April, and as we started seeing the money is coming back now to the system. So we expect, I think by, again, like you said, by July, we expect at least 80-100 crores should actually come back into the system. After the election, the government will start releasing the money. So that's the hope which we have today on that.
Okay. My second question is on this commentary that tractor sales have slowed down during elections. What exactly happens which causes a slowdown? Because it's, I'm just thinking why should why should a farmer not go and buy a tractor because it is election time?
Okay, it's a bit of a kind of a tactical situation that we face during elections. I mean, not so much in these central elections, but more so in state and municipal and other elections. But still, I mean, because we are a very kind of a push-based kind of a rural market, right? And a lot of states, get very politicized at the ground level, right? So, issues like such Achar Sanhita and, stuff like that. So it is the movement on the ground becomes a little bit tougher. I mean, the kind of market activations that you want to do to fetch more demand, all that stuff goes a little bit slow. A lot of people get engaged in canvassing, etc., etc. And just the kind of the environment that we have in the villages is not very, very conducive to sales. Right? So it's a very, very tactical reason. So that is one. I think on a more broader macro level, people kind of just tend to wait, till the election results are out, and they kind of start hoping that something will come out with the new government, etc. But I think that is not such a big reason. I think more so it is quite tactical in terms of the company's ability to kind of reach out to the customers, do market activations, etc.
Okay, Thanks. This is useful. On FY20, I think on the tractor side, you said your margin ambition is a 40 to 50 bips improvement. On the market share side, what is the ambition for FY20?
Yeah. So, I mean, we are, as I said, we are going to continue to beat the industry. And as per our Vision 2022 document also, we want to grow at least 1% market share each year. And last year, we grew about 1.1%. So we'll try to repeat that kind of a performance going forward.
Okay. Thank you.
Thank you. The next question is from the line of Bharat Genani from Sharekhan. Please go ahead.
Thank you for the opportunity, sir. Just elaborating more on the question asked previously. The tractor EBIT margin, you have guided for 40-50 basis points of improvement on FY20. So I think you have achieved 40 basis point improvement in this year on a very strong volume growth of about 20% or so. And FY20, obviously, the volume growth will not be that much. So what gives you that kind of confidence that we may, achieve, we may still continue to improve the tractor margins? So that would be my first question.
But then, first of all, the guidance which we given for the margin is at a company level, not specifically for tractor segment. So, secondly, I think if you look at overall last year, we obviously have improved the margin by about 100 basis points at a company level or EBIT level. And then obviously there are a lot of cost initiatives which are underway. So even though the operating leverage may not be there next year, the kind of leverage we got last year, but still going forward, the kind of initiative which we are underway, which the impact of which will start coming in from second half of this year. So maybe you may not see the same sort of margin improvement happening now in the initial first or second quarter, but maybe toward the end of second quarter or third, fourth quarter, we'll see the impact of those initiatives coming onto play, especially on the material cost front, which you're working on today. So those initiatives will definitely play out, and we think overall at a company level, getting that sort of margin improvement is a possibility which exists today.
Okay, so what would be your, specifically if you would like to give guidance on the tractor segment, specifically if you would like to give some guidance on the tractor
segment? So like the tractor obviously will be the largest segment, so it can't happen if 38% volume is coming from tractor segment on the top line, so the major impact will come in the tractor segment only in this. When the railway, we're not looking at any margin expansion there compared to current year, so railway active will slightly go down. It's only construction which we think some improvement. So both of them actually typically railway construction we get more or less balanced out. So essentially it will be left only the tractor business.
Okay. And that you're saying that is contingent on if the industry goes on the higher side of the band, I mean sort of 8% kind of a growth.
That's right.
Okay, fine sir. Thanks and all the best.
Yeah, I also, this is Shenu here. I also want to add that, one of the major challenges in the tractor business we are facing right now is the product mix. You would all remember that last year in around January 2018, we had taken a strategic call to launch several new products in the segments which were actually not that remunerative. Right? So, for example, in farm track, we never played below 45 horsepower. And then in January 2018, we launched a couple of products that were below 45 horsepower. We also launched a ride special tractor, and we launched a compact tractor for orchards. Right now, those tractors, all of those tractors were not very remunerative in kind of contribution that we normally do, especially in the farm track range of products. And but we consciously made that call in order to kind of cater to the market and in order to grow, in certain markets the way we wanted to. Now, after having launched those products for about 12 to 15 months, those products have established quite well in those markets, right? So now we are in a better position to kind of look at their contribution, both in terms of cost savings, but also in terms of the price positioning, and see whether we can probably generate better contribution from those models now, since we have significant volume from those and they have established quite well. Now, very recently, we took a price increase on some of these models, which will help us going forward. And in future also, we are going to continue to look at those avenues.
Okay, sir. That was very helpful. Thanks a lot and all the best.
Thank you. Ladies and gentlemen, we will request you to please limit your questions to one per participant. For any further questions, you may come back for a follow-up. The next question is from the line of Prateek Poddar from Reliance Nippon Asset Management. Please go ahead.
Yeah, hi sir. So just one small question, which was regarding your tractor guidance for the industry being at 8 to 10%. As you just said in the initial comments that 10% of the tractor sales come from subsidies, and in case if there is a scenario wherein there is no subsidies doled out by the state government or by the central government next year, is it fair to assume that then in that case industry growth would be flat?
Yeah, it's kind of sorry about that, but it's kind of a hypothetical question because I mean there is no scenario like this that will happen. I think subsidies will be there for sure. I mean we are just kind of speculating at this point of time how this will pan out, but we are not looking at any scenario where there will be no subsidies at all, right? So and there are few things already in the offing in several states that those will be kind of rolled out after the elections. So I don't think there is any scenario where we have no subsidies at all. Maybe it's slightly better or slightly worse than what we have seen now.
And sir, what are the assumptions broadly when you guide for an 8 to 10% industry growth? Just wanted to understand what is the basis of that. On what basis, are we projecting that kind of tractor growth?
Yeah, we are actually projecting 5 to 8, not 8 to 10 right now, for the whole year FY20. But of course, there are a lot of external research and internal research that we base it on. I mean, there is a lot of statistical data, but most importantly, I think what we have going for us is the pulse on the ground. Right, so there are a lot of, we sell tractors in villages every day and we interact with our customers every day. So we know what is happening on the ground, right? But so that gives us a fairly good idea of what can pan out, of course, with some limitations. And then we also rely on a lot of external reports, of different agencies and see what they have to say.
Great, sir. Thank you and so much and all the best.
Thank you. The next question is from the line of Riken Gopani from Infina Finance. Please go ahead.
Hi, sir. I just have one question. I'm still not very clear, hence I may be repeating the question. But, compared to where we were at the end of third quarter, expecting some reasonable numbers for the industry for Q4 as well as Q1, what necessarily has gone wrong for us to see such sort of a change in trajectory for us as well as for the tractor industry? You touched upon elections as well as harvest. Maybe are these the only factors, or is there anything? Because we've also heard from some consumer companies trying to outline that rural markets are in some sort of a stress and the demand there is weak across even other auto companies. Are there any other trends that are emerging which may sustain even after the elections in which are causing this pain in the rural markets?
No, so see, I don't think something extraordinary has gone wrong here because I think we were always, even at the end of Q3 or sometime in Q3, we were projecting about 10% for the whole year, 10 to 11, and it ended up at 8. So definitely quarter 4 was a little bit of surprise, but we always knew that we were sitting on a very, very high base in quarter 4, right? And I always used to say that in 2018 we grew by about 49%. So it was a bit of a kind of it was a situation where things could go a little bit wrong, right? But speaking, on the situation on the ground, I am actually a little bit more optimistic than what we read in the newspapers right now because what we see on the ground is not as bad as we read in various things, right? So I think the sentiment is quite positive. I think the only two fundamental factors that are not rated very high is the water reservoir level, which actually depends on the monsoon. And if we believe the IMD forecast of a normal monsoon, then hopefully that should turn out to be very positive. And the second is, of course, a high base, right? So we have had 3 years of splendid industry growth. And there is a chance definitely, that we will have probably a year of mellowed down industry growth this year. I think other than those two, there is no negativity on the ground in farmer's mind or anything that we go will drag the industry.
Understood. And sir, if you could touch upon the finance situation, the percentage vehicles financed this year for you, and what is internally financed by your own finance company, Escorts Finance. If you could highlight those aspects.
Yeah, so of course, this industry is very dependent on finance, on retail finance, and somewhere close to 92 to 95% of the tractors are financed. So only about 5 to 7% of the tractors are bought on full cash, right? So it's a highly dependent industry, but the situation on the financing side is very okay. We are not facing any challenges. Now, as far as our virtual joint venture with PLL is concerned, which we call Escorts Credit, there we are reaching about 15% penetration levels, right? And of course, we are going to continue to grow there as we go forward.
Understood. All right. Thank you.
Thank you. The next question is from the line of Mayur Malik from India Nivesh Securities. Please go ahead.
Hi. Two questions. One on the VRS. So I remember that, a couple of years back, we were trying to do VRS for about 1,000 employees, of which about 400, 450 had taken it, and we were waiting for a natural retirement of those in the next 3-4 years. So wanted to know that has that retirement happened, or and can we expect substantial savings in the staff cost going forward?
I think the retirement obviously is happening because last year also, so on an average, when we guided this, we had given a VRS scheme at that time where almost 450 employees have exited spread over 2 years. And after that, about 150 employees were getting retired every year. That attrition obviously is happening in terms of the normal course, though now the labor attrition has come down to about 90 to 100 employees a year on an average. So yes, the numbers have come down. So if you look at the last 5 years, I think from the regular workforce close to 4,000 plus workers, today we are down to about 2,000 numbers. And the number is further depleting. There's no further addition happening on the regular manpower. So that obviously is coming in line, which is why I think you see the manpower cost also on our P&L this time. And from a high of 11 to 12% is now down to about 7.2% this year. So that correction has been obviously the result of all the initiative what company had taken in the past.
So do we expect further savings on those lines, or this is where we will steady out?
We don't think it will be really easy to go down further from the current level, and especially since now the operating leverage may not really work to our advantage going forward. So that could be one bit of challenge. So yes, the company is still working on looking at ways and means of actually managing that cost going forward, but we don't think it will have any significant impact on the overall percentages and the cost really and on this account.
Right. And just secondly, on your gross margins, so is it really fair to understand that because the material cost in the international market, there are some which are going up, and there is this variation. So just wanted to understand that how directly does it impact us in terms of the lag effect? Do we expect a higher cost going forward because of this increase in steel prices?
As we look at the last few quarters, I think 6 to 8 quarters, the inflation has been pretty aggressive, especially on the steel side, but also with the government imposing anti-dumping duty on the steel. So obviously there was an impact now on the commodity prices side, and which is the one also which was impacting our margin in the construction equipment business. Though in the tractor business, we were able to pass on the increases to the market, though with a lag of about a quarter. But in construction, we had faced that challenge, and we were actually sitting on some of the inflation which we are not able to pass into the market. With every contract deal, there is a negotiated deal, unlike in tractor business, which is more like stock and sell model to the channel partners. So, but going forward, we expect, I think, if the industry softens further, and you're seeing that impact happening across auto industry, so hopefully the pressure on commodity prices should not be there. But yes, if there's a global change happening on the prices, that definitely does translate to the impact on the Indian market too.
All right. Thank you so much.
Thank you. The next question is from the line of Siddharth Bira from Nomura Securities. Please go ahead.
Hi, sir. Thanks for taking my question. Sir, can you first indicate what will be the quantum of price increase we have taken in the tractor segment in this quarter?
In tractor segment, there is no price increase taken. And not in this quarter. We taken the price increase in the December quarter. I think end of November we taken after the season was over. We taken that impact, which is why I think in the last quarter we didn't see any impact really on the cost and pricing front. So there's no really requirement as of now to really take any price increase on the tractor side.
Okay, but in this quarter we have seen.
Just to clarify, as I was explaining, there were some new models that we had launched about 12 to 15 months ago, and we have taken a small price increase in those models to just balance our kind of growth and profitability objectives. But that is not a wholesome price increase. That is only on a couple of new models that we have taken in April.
Okay. So, but if I compare sequentially, the EBIT margins in the tractor segment have still come down quite a bit compared to the last quarter. So, just wanted to understand, I mean, is it entirely driven by adverse mix, or what has led to this decline in this quarter's margins for the tractor segment?
Yeah, so I think as I explained in the beginning also, the major impact is on account of mix because our sales volume in the sub 40 HP category has actually moved up from 53% to 56% in this quarter. So that had an impact because most of the sales which has happened in those segments really typically are the low margin products, unlike in the higher HP segment. So that does impact the margin significantly and also pushes the material cost ratio. If you look at even the financials on P&L side, the material cost movement actually is on that account.
Okay. So for an annual basis, you think that should normalize in next year?
Yeah, assuming the mix doesn't deteriorate further, I think if depending on, like I said, which states grow and which regions grow, typically if you grow in the states where the requirement is more for the higher HP tractor, then obviously the impact is low. But if you really look at the total rural belt of states like UP or Bihar, Jharkhand, where the growth is more on the lower HP side, so there obviously it does have an impact on the overall mix.
Okay. Okay, sir. Thanks a lot.
Thank you. The next question is from the line of Amin Pirani from Deutsche Bank. Please go ahead.
Yes. Hi, sir. Thanks for the opportunity. So my question is on the availability of finance at the dealer end for financing, the inventory. After the NBFCs have started to see, some pressures at the end of last year, there was some pressure, inventory levels were rising, not specifically for you, but for the industry. So what is the situation right now, and can that be a risk for volumes for next year? There is the availability of finance to dealers.
Firstly, the industry, I don't think is dependent on NBFCs for dealer financing for their inventory. Right, NBFCs are playing a very, very important role in retail financing, which is like when financing to customers, but not to dealers. Right, so most of the channel financing is coming from banks, right, and of course we have not seen any unusual phenomena or any phenomena that would scare us in terms of dealer financing. But of course, it is also true that the industry has gone through 3 years of substantial growth, right? And therefore, from a working capital perspective, dealers always find them kind of caught up in a situation where they need more capital, but it takes for them longer time to kind of raise that capital. Right? But other than that, there is nothing that that would like to comment on this issue, but. This year, if the industry forecast is lower at 5 to 8%, I don't think that would be a problem. Actually, that would possibly go in favor of the industry.
Okay.
From a working capital perspective.
Okay. Thanks.
Thank you. The next question is from the line of Kushan Parekh from HSBC. Please go ahead.
Hi, sir. This is Vivek here. Thanks for the opportunity. I just wanted to get a sense on dividend payout in the coming years. How do we look at it in the future years?
See, Vivek, I think overall, if you look at the cash requirement for the companies, one, obviously we explained the scenario which we are in today with the high working capital, which is actually moved up significantly. And probably it will take us 3-4 months time before we bring it down to this normal levels. And also, I think for the next year, if you look at the requirement of cash, I think we have requirement of about 250 to 300 crores of capex, which is lined up for FY20. And part of it is a spillover from the last year, with this entire capacity expansion on the machining side, which was supposed to happen last year, didn't happen actually, so that got delayed and is now happening in this year. On top of it, there is also investment which will happen in the joint ventures that the company has entered into. So we had done some investment in last year also. So the second installment or second phase of those investment will happen actually in this year, which will be close to 80-90 crores, which will go into these joint ventures. And then obviously going forward, there's also some pressure from the government perspective. You look at there's some new requirement coming up on the MSME vendors front. So the government is pushing a lot to bring down the payment terms to these suppliers. And in our case, it's almost 250 odd suppliers are actually into this category, where we were enjoying earlier the extended payment terms. So there will always be some working capital pressure which will be there from these suppliers. And on top of that, we had issue with the GST refund, which has been stuck now with the government for quite some time. So as we mentioned, we are close to 177 crores as of end of March, which is recoverable from the government. So I think all these issues actually come together, so which is putting a lot of pressure on the cash side, especially in the next year and probably the year after. So I think these 2 years we think may be tough. Maybe FY21 may not be that tough as probably FY20. So FY20 we still see a challenge in terms of the overall meeting this entire cash requirement. But FY21 maybe slightly an easier year. And on top of that, we also have aspiration to look at some inorganic opportunities for the railway segment, which again will require some sort of cash for the system. So we think FY20 will be quite tight months in terms of overall, I think, on the cash requirement. So that's why any further policy on the liberalizing on the dividend distribution side probably in this year looks very difficult. Maybe FY21 onwards, maybe when the things ease out, because most of these are one-time investment which are happening on the capacity front and may not be required going forward again, at least for next 5-6 years. So maybe 21 onwards, we think the cash position will ease out and probably company will be able to really reward the shareholders with much better distribution ratio.
Got it. Thank you, sir.
Thank you. The next question is from the line of Samir Deshpande from Fair Deal Investments. Please go ahead.
Hello, sir.
Hi, Samir.
Congratulations for the excellent results. And it is on auspicious day of Akshay Tritiya. The company has posted the highest ever sales and profits. So I think the investment in gold should be discarded and investment in our company should be considered for long term so that it will be a gold. So let us hope your results, your efforts yield results for the years going forward. I would like to know mainly we have sold our shares in Hughes Communications for 53 odd crores. So actually the cost in the balance sheet was some 45-46 crores. So have we booked that profit in other income?
No, so if we look at our policy, which is stated policy for the equity investment, any sale of the mark-to-market valuation for the equity investment actually is done through the balance sheet, not through the P&L. So the income actually was getting reflected in the other comprehensive income in the OCI below the profit line after the PAT, which comes. So the investment actually is happening on the balance sheet because it's not a normal recurring income which is there, which we never wanted to use in the P&L side. So P&L actually should reflect the normalized business operational level, and these are the income which normally are adjusted in the balance sheet itself. So whatever the book value was there, which was I think about 45 or 46 crores, against that we have received cash of about 50 odd crores, and the balance is still to come subject to the company getting the FDI approval for increased investment from their foreign parent. So probably that will happen during this year, and we'll see the balance cash flow probably will come into the company in this year.
How much balance cash flow is expected?
So overall, we expect it to be somewhere close to, I think, another 10 odd crores.
And these other expenses have gone up by 23 odd crores in the Q4 compared to the last year as well as the December quarter. So is there any one-off in that?
So you can't say it's totally one-off, but yes, like I said, so there have been some consulting which normally we are paying to the agency which is where we are working now. So that's a contract which is continuing and will continue probably the next year till FY20 end. So those are the payouts which are happening, and typically these are also linked to the performance in terms of the share of market and the profitability. So obviously the payout goes up as the market share also moves up, and we've seen the market share was highest in this quarter. So linked to that, since the variable payout, so the impact has come into this quarter. And on top of that, we also taken some provisioning for the inventories in this quarter, because we actually come out with a new policy which was approved by the board, where we are taking now provisioning for the inventory based on the aging, which is on a very conservative basis compared to what we used to do earlier. So that also has an impact of about 16-17 crores in this quarter, which has actually impacted the result. So obviously, if you take all those initiatives which are now getting built into this cost factor, so that has impacted slightly the margin and the overall.
Because 16-17 crores is quite a large amount. So if that is excluded, the impact on the margins will be actually nullified entirely, because it's 0.5%. That's right. And the last one is, do we expect to outperform the industry, tractor industry this year also, which we have been doing for last 2-3 years?
Yeah, Sameerji, this is Shenu. I mean, we really hope so that we will continue to do it, and not just because we have been doing it so far, but because we have some very fundamental initiatives in place, which we have spoken about in the past, both on the distribution side and on the product side. So we are very hopeful that we'll continue to beat the market this year also.
Okay, so let us hope the monsoons also bless us, and all the best to you people and all.
Thank you. Thank you, sir.
Thank you. The next question is from the line of Jay Mehta from Edelweiss. Please go ahead.
This is Chirag here. Sir, I have just one question on the on the demand side. Is it possible to indicate how is the demand breakup between new and replacement demand? Any color you can share? And which segment has seen?
Yeah. So, I'm sorry. Go ahead, please.
And which segment has seen a major slowdown between new and replacement?
So replacement demand, of course, is rising, and it will continue to rise as we go forward, because the more and more we reach the levels of saturation in the industry, of course, we'll have lot more replacement buyers. I don't think there has been a very, very significant shift. I mean, it's a very, very slow phenomenon. So it will happen over a period of 5-6 years, when we will see 2-3% shift in replacement versus new, because the industry is far from, we believe industry is far from saturation, and therefore it's a slow phenomenon right now. But it is increasing gradually, and it will continue to increase. Now, some markets which are very, very mature, for example, like Punjab and Haryana, in terms of tractor penetration, of course, maybe about 80% of the demand is replacement demand, while some of the markets which are very virgin right now, for example, like Chhattisgarh, Odisha, East, and some other markets, the replacement demand is as low as 30 to 40%. Right? So I think this phenomenon is going to continue, but it's going to go very, very slow until we reach more saturated levels in the industry.
And both the segments have seen a similar slowdown, or it is driven more by new demand?
Yeah, see, slowdown is very temporary right now, and March and April pretty much, and we can count maybe Q4 until Q3, things were pretty violent, right? So it's hard to say, what it is. We don't have data to share right now on this, but maybe separately I can look at the data and respond to you.
Yeah, so just one clarification you indicated on this 5 to 8% growth. If you look at that, some of the regions like West and South, even if we have a reasonable monsoon, are unlikely to see a recovery. So are you making a case that the other regions could grow in a strong double digit, and hence the average growth of 5-8%? Is this the way?
Oh, definitely.
So, okay.
Yeah, definitely. So, even if you look at I'm sorry. Yeah.
And would it be a right statement that South and West may not see a further decline in sales. Is that a base case that we should work with, or if monsoon is weak, or even if there's a normal monsoon, sales could be lower than this year in South and West?
Yeah. So I see if you look at the figures of the last year, I think we have also shared it in the opening statement that overall the market grew in India by 8%, while North and Central grew by 13%, and the South and West grew by about 2 or 3. Right. So we think, the same kind of distribution will continue to happen for this year also, at least in FY20. But FY21, the situation could be different. South and West could be more prominent in terms of growth if we have a good monsoon this year.
This is helpful. Thank you very much.
Thank you. The next question is from the line of Harshal Agarwal from CRISIL. Please go ahead.
Hi, thank you for the opportunity, sir. I am eager to know your guidance for the exports for the tractor industry in this fiscal, and which markets will drive the growth for the industry, and what other factors can aid the growth.
All right. So this last year, FY19, the growth in the export industry was about 4 to 5%, while of course we have grown by a much larger percentage, and that is mainly because we are sitting on a very, very low base. So going forward, I think we will see possibly similar kind of trend of growth in overall export industry out of India. Now again, since we are at a very low base of about 3,000 tractors this last year, our ambition to grow is much more higher. We have shared with you in the past that the company has invested a significant amount of resources in creating our export product lineup, which is now pretty much ready. And now, therefore, the focus has, for the last few months, has shifted to expanding our distribution in important export markets, which we are continuing to do. So definitely will grow much better than the industry in growth, and hopefully, as per our Vision 2022 document, we want to reach a figure of about 10,000 by 2022. So in line of that, we hope we will do somewhere close to 4,500 to 5,000 tractors this year.
And which markets will actually drive the growth for the industry?
Yeah, so there are a few focus areas where we will drive in the volume. One of these is Europe, where we will drive in some volumes. You are also aware about our relationship with Kubota, where we are trying to utilize some of Kubota's international or overseas network to drive our exports volume. Right, so a lot of these factors are going in favor of us. A new product line, better distribution outside India, and of course this relationship with Kubota. All these will help to garner some pace in export volumes.
Okay, thank you.
Thank you. Ladies and gentlemen, we take the last question from the line of Mumkush Mandlesha from MK Global. Please go ahead.
Hi, sir. Raghu here again from MK. Sir, just wanted to understand on the new products, which is the Atom series and the Rice Specialist tractor, how much was the volume in FY19, and how do you see the improvement going forward?
So I'm sorry, Raghu, I don't have the volumes right now. Maybe Bharat or Prateek can help with that. But definitely these are the markets where we have just entered. I mean, we were one of the late entrants in these markets, as you know. And therefore, we will continue to see a substantial growth in these segments going into this year and also in future. Prateek, do you have those numbers for Atom?
On Atom, we did about 1,000 plus tractors in FY19 on a full year basis. And which other model you said?
Rice Specialist tractor.
Rice Specialist.
Rice Specialist is still under field trials. There's very small volume. I think this year we've done only 40-50 odd tractors.
Understood. And that should increase, sir, substantially, because I think the rice market, as you had previously indicated, was as large as 1 lakh units per year.
Yeah, rice market is pretty large, but this is a very unique tractor. This is kind of a tractor that is not available with all the manufacturers right now. This is a very lightweight kind of a tractor. We call it crossover because it's kind of a mix of a very specialty rice tractor versus a normal utility tractor. Right? So we are going very carefully with these tractors because this also means that we have to change some practices on the ground. Which we have received very, very positive response from this in many parts of the country. And we are going to continue to promote this concept of this new kind of a rice tractor. Now, as far as compact is concerned, that market is definitely quite large now. Although a large portion of this market is in Maharashtra, which is not going through a very good pace of growth. But still, since we are a new entrant, we have a huge opportunity to kind of expand our volumes here.
Thank you, sir. Some clarifications. One is on the gross margin side, there is some improvement QOQ on the gross margin. What has led to that, sir?
Nothing for the quarter or
for the quarter, sir. For the quarter, if I take QOQ basis, raw material to sales, there is some improvement QOQ. What has led to that?
The price increase which are taken towards the end of last quarter. In November, we taken the price increase to pass on the inflation. So obviously in this quarter, the full impact was there, and there's no further inflation in this quarter, which is why we're seeing the better material cost ratio in this quarter compared to the sequential one.
Thanks for that. And so on the construction equipment side, the QOQ increase in realization, what would be the contribution of price increase in that? Because, the remaining part I understand is the mix, which is favorable. But how much price increase was there in construction equipment?
So increase was in the range of 4 to 5%, which was basically, like I said, the lag effect of the inflation which has been there, which we not able to pass on. So with this price increase, we've been able to neutralize that impact really on the commodity prices.
Understood, sir. And so, one more clarification: the GST refund that would be part of the current assets, right? Other current assets item.
That's right. Yeah.
Got it, sir. And just one last clarification. On the investment side, Kubota investment was at 1.2 billion and Tadano was at 0.3 billion. So how much has been done in FY19 and how much is expected in FY20?
So Kubota, we've done 50%. So 60 crores had gone last year in March and 60 will go in this fiscal year in FY20. On Tadano, initial investment was about 60 crores, out of which our share was roughly 30 crores, which has gone last year. But there's some product preponement which they are looking at, so there's some more capex which really will be required. So about 20 crores they are projected further for the JV, out of which our share will be about 50%.
And so capex was expected at 2.5 to 3 billion in FY20. How would be the breakup of that capex?
So like I said, the major capex was actually the deferral of the machining capacity expansion, which was scheduled to happen last year, but we placed the order slightly late and also looking at the kind of requirement which we had, so it got slightly delayed. So that roughly close to 80-90 crores, which will likely get spent in this year. And then there's investment which is being done. So there's a normal capex of about 60-70 crores across all three businesses, which is there. And there's some investment which you're doing on the product side, especially on the emission norm changes which are happening now, since we're moving to the Euro 4 or the Bharat 4 Trim 4 norms for both construction as well as for the tractor business. So that investment which is ongoing. We're also looking at some revamp of the entire product portfolio in the looks and design and the feel. So that again will need a lot of tooling investments, and it's more on the tractor side. But in the construction and railway side, we think it will be somewhere close to 30-35 crores, and balance is more on the tractor business side.
And sir, BS4 will come from April 1st, right?
It's October 2020.
October 2020.
For the higher HP models, 50 HP.
That is for only
the construction equipment only, right?
Both tractor and construction.
Understood. And what about the entire portfolio?
There is no date for that yet. The only date we have right now from the government is 1st October 2020 for diesel engines above 50 horsepower.
Understood, sir. Thank you, sir. Thank you so much for those clarifications.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to Mr. Bharat Madan for closing comments.
Thank you, ladies and gentlemen, for being present on this call. For any feedback and query, feel free to write in to us at investorrelation@escorts.co.in. We'll meet again in next quarter. Thank you very much and have a very good evening.
Thank you. Ladies and gentlemen, on behalf of SBI Securities Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.